Hey there, savvy investors. It's Iggy from Investing Iguana, and today I'm thrilled to bring you a crucial topic in the world of investing: smart investing, calculating the ideal price for your stock picks. In this video, I'm going to unveil the secrets behind determining the right price to pay for a stock. We'll explore the intricacies of stock valuation, break down different investment strategies like value, growth, and dividend investing, and I'll guide you through practical methods to calculate the fair value of stocks. Whether you're a seasoned investor in Singapore's dynamic market or just starting out, understanding how to correctly price your stock picks is a game changer. So, buckle up as we dive into the world of smart stock valuation, helping you make more informed and profitable investment decisions. Understanding stock market dynamics. First, let's delve into this fundamental truth of the stock market. Imagine you own a stock that's worth $100. If the value of that stock drops by 50%, it's now worth $50. This is a straightforward calculation. 50% of $100 is $50, and when you subtract that from the original price, you're left with $50. Now, here's where it gets interesting. To return to its original value of $100, that $50 stock needs to increase by 100%. This is because 100% of $50 is $50, and when you add that to the current price, you're back at $100. So, the stock needs to double or increase by 100% to recover its original value. This isn't just a mathematical oddity, it's a reality that many investors face in the stock market. The market will inevitably have periods of downturn where the overall prices of stocks decrease. These downturns are a normal part of the investing journey. Understanding this concept, that a larger percentage gain is needed to recover from a loss, is crucial for long-term investing success. It can influence decisions such as how much risk to take on and underscores the importance of strategies aimed at preventing large losses. This understanding is a key component of successful long-term investment strategies. The art of value investing. Value investing is an investment strategy where stocks are selected that trade for less than their intrinsic values. Value investors actively seek stocks they believe the market has undervalued. So, imagine you're considering investing in a Singaporean company that owns a valuable piece of real estate. Instead of focusing on the company's earnings, a value investor would look at the underlying assets, such as the real estate. The price you pay for the stock is crucial. The goal is to find stocks trading for less than their book value, which is the value of the company's assets minus its liabilities. The idea is to find that sweet spot where the market hasn't yet recognized the true worth of the assets. This could be because the company is under the radar, or because it's been overlooked by other investors. However, this approach isn't just about finding cheap stocks. It requires patience and a keen eye for spotting undervalued assets. It's also about understanding the potential risks involved and being willing to wait for the market to realize the asset's true value. This could take time, and there's always the risk that the market won't recognize the asset's true value. But for those who are patient and make well-informed decisions, value investing can be a profitable strategy. Dividend investing, a quest for consistent income. Dividend investing is a strategy that focuses on buying stocks that pay dividends. Dividends are a portion of a company's earnings that are paid out to shareholders, providing them with a steady income. This strategy is particularly popular among Singaporeans. If you're a dividend investor, your primary focus would be on the company's ability to consistently pay dividends, rather than the fluctuations in the stock price. The appeal of this strategy lies in the sustainability of dividends. Even if the stock price falls, it could present an opportunity to buy more shares at a lower price. This could increase your dividend yield, which is the annual dividend payment divided by the stock's price. So, instead of focusing on short-term price fluctuations, dividend investing is a strategy that focuses on long-term income generation. It's about the steady income from dividends and the potential for this income to grow over time if the company can sustain or increase its dividend payments. This approach requires patience and a keen understanding of a company's financial health and dividend history. But for those who value consistent income, it can be a rewarding strategy. Figuring out the right price to pay for a stock. Determining the right price to pay for a stock is a crucial aspect of investing. It involves understanding the company's financial health, its future prospects, and how it's valued in the market. Let's say you're interested in a particular stock. You would start by looking at the company's financial statements to understand its profitability, debt levels, and cash flow. This gives you an idea of the company's financial stability and growth potential. Next, you would consider the company's future prospects. This could involve looking at the industry it operates in, its competitive position, and any potential risks or opportunities on the horizon. Finally, you would look at how the market values the company. This involves looking at valuation metrics like the price-to-earnings (PE) ratio, which compares the company's stock price to its earnings per share. If the PE ratio is lower than other similar companies in the market, it could indicate that the stock is undervalued, and therefore, it might be a good time to buy. However, it's important to remember that these are just guidelines. The right price to pay for a stock can vary depending on a variety of factors, including your own investment goals, risk tolerance, and time horizon. In summary, navigating the stock market requires a nuanced understanding of different investment strategies, whether it's value investing, dividend investing, or betting on innovative companies. In Singapore's vibrant market, these approaches can offer unique opportunities and challenges. It's about aligning your investment strategy with your financial goals and risk tolerance. Remember, successful investing is not just about the price you pay, it's also about the performance and potential of the business behind the stock. And that's a wrap on our deep dive into smart investing, calculating the ideal price for your stock picks. Thank you for joining me on this journey through the complex yet fascinating world of stock valuation. I hope this video has provided you with valuable insights and tools to enhance your investing prowess. If you found this content helpful and enlightening, please show some love by hitting the like button. Your support is what keeps our channel thriving. Don't forget to subscribe to Investing Iguana for more insightful content that demystifies the stock market and helps you navigate it with confidence. Have any questions or want to share your stock valuation experiences? Drop a comment below. I love hearing from you and learning together. Until next time, this is Iggy, reminding you to invest smartly and strategically. Stay curious, stay informed, and I'll see you in the next video.